Hi, everyone. We are Group D, and we are here to discuss the Philips case, which is about taking ESG beyond a market employee to an impact factor that affects the model's cash flows and eventually the company valuation. Going straight to who Philips is, it's a healthcare company that's based out of Netherlands, and they are focused on improving the health and well-being of the population. They have two main business lines. They have one for individuals and one for healthcare professionals. Their main value proposition for individuals is to help them improve and monitor their personal health, while for healthcare professionals is to provide them the tools that they will use to improve and monitor the well-being of their patients. In terms of who they are, they're actually a global leader in all of the business segments that they operate in, and their main value creation is that they improve the treatment success rates and health outcomes through innovation in the various business segments that they operate in. Moving away from who they are to their main value drivers, they have three. They have sales growth, margins, and capital. One thing that should be noted here is that recently, Philips, according to the case, Philips is shedding their conglomerate structure to focus more on developing solutions. And historical data is not a good measure of looking at what they will do in the future, since their business model has changed dramatically. So for sales growth, they believe that in future it will be 4 to 6%. For margins, it will go from what it is currently, which is 11 to 12% to 15%, and that the WACC and other rate will remain at about 8%. Now, looking at the table on the bottom right, which is the crux of our discussion today, is how do ESG factors affect value drivers, which in turn will affect the valuation of the company. In terms of the case, Philips arrived at a fair value stock price of 48 euros, which includes the upsides from ESG factors. And they believe that without ESG, they will go as low as 39 euros. Now, are these claims justified? That is what we are going to talk about in subsequent slides. Moving on to what their ESG factors are, they have many ESG factors that affect healthcare companies, but these three that they mentioned in the case are the most critical according to them. Now, going to what material ESGs are, these are factors that are most critical to the business model. That means that they will affect either the financial performance or the operations of the business in the future. One of them, according to Philips, is innovation, and we as a group totally agree with that. We believe that innovation management is a critical ESG factor, as it aims to create a cohesiveness between the use of the materials for their tools and how those materials are either used or disposed at the end of life. Secondly is human capital. While human capital does not affect value drivers directly, they affect innovation, because the better people that you have hired at your place, at your business, the better the innovation, right? So innovation affects value drivers, and that's how human capital comes into place. The third one, which we as a group don't necessarily agree with, is energy efficiency and circular economy. We believe that as a healthcare company, energy efficiency is not one of those factors that are material enough, especially if you're not in places like industrial, transport, or the utility sector. Hence, in our DCF model analysis, we actually did not include energy efficiency. In terms of social reputation, this was not mentioned in the case, but we as a group believe that this should be an important factor. Philips is a healthcare company and they are highly regulated. In fact, marketing activities are even more regulated in the healthcare industry. And if they want to grow, they need to leverage a social reputation to expand and access new markets. Because once people know them that they are good ESG companies and that they have a good reputation, they are more inclined to using their products. Finally, we'll look at, now that you have identified these ESG factors, how can you integrate them into your model? And the approach that we are using today is called the value driver adjustment approach, which is the VDA approach for short. The first thing is identify the most material ESG factors, which we did in the previous slide. The second thing is to analyze these factors and see if they will give you a competitive advantage. Obviously, you have to know if you are a global leader first, and this will give you, well, not necessarily a global leader, but you're ahead of competition, and that these ESG factors will actually give you an additional competitive advantage compared to your peers. So for Philips, it's innovation, which we say it's a big yes. Human capital, kind of yes, because it affects innovation. Energy efficiency and circular economy is a maybe. Now, after you're able to identify and analyze these factors, the next thing you need to do is to quantify and adjust your model to take into advantage this factor. So you make educated assumptions. What you need to do is to basically look at these factors and say, how will they affect the model and what will be the likely impact on the model? And whether it's going to be adjusted positively or negatively is up to you as the analyst to do. So according to the Phillips case, innovation will affect sales growth and margins. Sales growth by 1%, margins by a certain percentage. Human capital is linked to innovation. And they also claim that energy efficiency and circular economy will increase margins by 2%, which we do not agree with, and we'll talk about in the subsequent slide as we integrated this in the DCF model.
After analyzing the DCF shown in the case, we noticed that there were some inconsistencies in the information presented, producing an irregular modeling. Therefore, we recreated the model within our possibilities, having several assumptions. The DCF assumes that the growth is going to jump from 2% to 4% in 2019, but depreciation will remain higher than CapEx. And not only that, but in the following periods, CapEx will be behind growth in every period until reaching perpetuity, while the company's sales will increase at a 4% every year. This doesn't seem reasonable to sustain this level of growth with higher depreciation than CapEx. So to correct this, we made two assumptions. The first one is that depreciation is well calculated, but CapEx is lower than what would be consistent with this growth. The second one is that the market value of the company does not make this mistake and considers the appropriate CapEx to depreciation ratio for a 4% growth. Therefore, we should change the CapEx over sales ratio to match the market valuation of the company. With these assumptions, it was obtained a CapEx over sales ratio of 9.66, as you can see, which is constant for all periods, followed by CapEx being equal to depreciation in perpetuity. This gave us a fair value stock price of 36.50. We also did the exercise of doing the DCF without the ESG effects, and stock price calculated was 31.20, which is lower than what the company calculated with the ESG effects. Now, we also did our own adjusted DCF with what we believed are the appropriate ESG effects. As for the innovation part, it is informed in the case that Philips is truly strong in innovative management, although later the case assigns an extra 100 basis points to sales because of innovation when interacting with other factors. The isolated effect of innovation in the cash flow of the company is established to be an extra 50 basis points for sales growth and an extra 100 basis points for EBIT margin. And as for the energy efficiency and circular economy, the case assigns a value of 200 extra BPS to the margin due to the interaction between innovation management and energy efficiency. And as mentioned before by Funmi, it doesn't seem to be a situation to consider energy efficiency as a relevant ESG factor for this company. Therefore, this or its cross effects with innovation should not be considered. Due to this, we didn't assign an increase for energy efficiency. And now, as previously mentioned, there is an argument to be that being considered a company highly committed with creating social value, this one has a potential to impact the company's cash flows. So for this exercise, we assigned to the social reputation an effect of 100 extra basis points for sales growth that would leave Philips close to the upper limit of what is an expected growth in this industry, but 100 basis points less of margin, which would leave it as the standard level of margin expected for the company. with these adjustments, we had a calculated stock price of 36.10, 40 cents lower than the one calculated by Philips with their ESG effects.
Thank you, Angie. So I'm going to be talking about the VDA approach, the benefits and improvements of the same. Starting with the benefits of the value-driven approach, the first one is ESG integration. It basically bridges the gap between sustainability and finance, and by linking it to financial models, value drivers, and the competitive analysis. The second is the framework guidance. It provides framework to incorporate ESG issues into the investment decision. The third is strategy and operations. With this integration, eventually, strategy and operation decisions and the long-term prospects of the firm will be based on that. Lastly, the integration of sustainability factors links the value drivers to the financial models, making them forward-looking. Moving on to the downsides of this approach, the first one is the lack of standardized guidelines. The approach is subjective and requires estimation. This can definitely cause ambiguity in valuation. The second is that the estimation is subject to biases. Linked to the previous point, there's a high chance of personal biases that can come into the estimation. The third is that it ignores length of the impact, basically how long it takes for the competition to catch up and erode value. Then materiality may change and the time it kicks in may change as well. Lastly, the effect of each factor is not equally significant, and in every sector, in every industry, there need to be different factors that need to be used. Moving on, the last question we're trying to answer is ESG decision making and what are the factors we should look at. So the first one is shareholder value, and we believe that the impact on shareholder value should be considered while making ESG decisions. In case of sustainability, it has been shown in a lot of different researches that it does bring positive long-term effects on shareholder value. However, sometimes the shareholders' priorities to have short-term yields, and this affects the board's decision or the company's decision to only focus on shareholder value and eliminate the ESG factor, but we do not think is true. Having said that, we do believe that shareholder value is one of the most important factors that we should incorporate into ESG decision making. Other factors that we think that are important are cash flows and the weighted average cost of capital. If an ESG factor has a measurable effect on payments and the cost of capital, it is important to consider it in the analysis. Secondly, we think companies need to broaden their perspective, their scope of stakeholders, and think beyond just shareholders and the value that they create for them. We should look at other entities that like employees, their customers that are affected by these decisions as well. Third are risks and regulations. All around the world, regulations around ESG are becoming necessary, and integrating them today will help the firm stay ahead of the curve. Identification of material ESG factors. ESG decisions of the firm should focus on the identification, measurement, and reporting of material issues. There has been a lot of research that shows that companies need to first identify material issues for their company and then have the ESG decision making based on those material issues. If a company is only focusing on something that everybody in their industry is doing or all the competitors are doing, they lose the strategic advantages that can come from differentiating themselves and by foreseeing what can come up in the future. Thank you.